Finance. Dear student, the following presentation is in the form of short paragraphs and bullet points accompanied by an audio voiceover by a lecturer. The worksheets that accompany the presentation go into much more detail to help you pass with flying colours. We are here to help you achieve. Startup costs. These are things to spend money on before you start trading. So, for example, a driving instructor needs a car. A print shop needs a computer and a copier. If you have savings or friends or family can help, then great. Otherwise, you may need a bank loan. Running costs. These are the day-to-day costs. So, for example, a driving instructor will need to keep filling up with fuel. The print shop will need to keep buying paper as well as pay for electricity. Fixed costs, also known as indirect costs or overheads. These must be paid no matter how much you produce or sell. A driving instructor has to pay tax and insurance. A print shop has to pay for heating and lighting. Variable or direct costs. These are directly related to how much you produce or how much you sell. If a driving instructor has a lot of clients, he will use a lot of fuel. If a print shop's in demand, they will use a lot of paper and ink. Total costs is fixed costs plus variable costs. Revenue is any money that comes in. Now, the main way is probably going to be through sales, but it could be through rental income. So maybe you've got a property or a room and you can rent that room or property out to other people. Interest received on bank savings or investment income. So revenue from sales is number of items you sell times the price per unit. Expenditure. This can include rent, salaries or wages, raw materials to make products, packaging, gas, electricity, water, phone, Wi-Fi, vehicles, fuel, paper, advertising. Profit, revenue minus expenditure. Break even is when you're not making a profit, but you're also not making a loss. The calculation is fixed costs divided by selling price per unit minus variable cost per unit. So imagine a guy is selling hot dogs. His fixed costs per week are £100, and he is selling them for £1.30, and it costs him 80p per hot dog to produce. So how many hot dogs would he need to sell before he starts to make a profit? Well, that would be 100, your fixed costs, divided by 1.3 minus 0.8, and that comes to 200 hot dogs, and then he has broken even. So here's the break-even diagram. Now, this steep line here, that is your sales line or your revenue. And this slightly gentler slope here, that's your total costs. So the point at which the two will meet, right in the middle here, that is where you break even. And in this case, it's when you've made 4 covers and sold 4 covers. The margin of safety is how much you're selling more than the break-even point. So actual sales minus break-even sales equals your margin of safety. So Tom is selling Christmas trees. He can hire a van. He can employ 2 friends and rent a showroom, all for £4,000. He can buy the trees for £30 each, and he wants to sell them for £50 each. He thinks he can sell 400 trees. So what is the break-even point? Well, remember it's fixed costs divided by selling price per unit minus cost per unit. So it's 4,000 divided by 50 minus 30. So 4,000 divided by 20. So 200 trees, he has broken even. So he thinks he can sell 400 trees. So his margin of safety would be 200 trees. If he sells 300 trees, then it will be 100 trees safety. Now, things can change. If your sales increase, then your margin of safety will increase. So you're selling more now above the break-even point than you were before, which is a good thing. If your sales decrease, then your margin of safety decreases. You're getting closer to that break-even point, which you don't want. If your costs increase, then the break-even point will go up. That's a bad thing. If your costs decrease, the break-even point goes down. That is a good thing. So, what can you do? So if your costs increase, you could think about trying to buy cheaper materials. You might be able to renegotiate with the supplier, or you may switch the supplier altogether, or use different materials. Now, you could also try to use less electricity, less fuel, etc. So break-even analysis is useful because you know the fixed and your variable costs. You can calculate your projected sales. You know how many items you need to sell to make a profit. You know the margin of safety. You can stock and sell the best goods at the optimum price, and you can review your costs and maybe make cuts somewhere. So what are the risks of not doing break-even analysis? Well, first of all, your costs will be unknown, and therefore your costs might be very, very high. Your selling price could be too high, it could be too low. You have got no idea how many items you have to sell to make a profit. You could be making a loss without taking any action because you don't know until it's too late. Your margin of safety is unknown. Your stock may cost too much. You could be selling at the wrong price, and your business could certainly fail. Let's do a worked example. So Kate wants to make and sell bread. Each loaf costs her 50p, and she wants to sell at £1.50. It will cost her £20 to rent a stall and £10 for petrol. Some weeks are good, some weeks are bad. One week she only sold 10 loaves. So let's do the break-even figures. So break-even point, remember, is fixed costs divided by selling costs per unit minus variable costs per unit. So in this case, your fixed costs are £30, £20 plus 10. You're selling for £1.50, it's costing you 50p, so that's £1 difference. So 30 divided by 1 is 30 loaves. So if she sells 30 loaves, she will break even. Okay, now when she sold 10 loaves, she made 10 times £1. But then she also lost her fixed cost of £20 and £10, so she made a £20 loss. Now, Kate then had a lucky break. A food chain offered to buy 2,000 loaves a week at a reduced £1 per loaf. She will now need bigger premises and more equipment. So now it's costing her £10,000 a year for rent and rates. New equipment is going to cost her £15,000 per year. It's going to cost her £2,000 to run a van, and electricity and office will cost her £3,000. Right, now let's assume that it's still costing her 50p to produce each loaf. So let's do a new figure analysis. So 10,000 plus 15,000 plus 2,000 plus 3,000, that comes to £30,000. Okay, divided by selling price, which is now £1, minus cost, which is 50p. So 30,000 divided by 0.5 gives you 60,000 loaves per year to break even. So she is selling, remember, 2,000 loaves, and let's say she's doing it 52 weeks a year, so 2,000 times 52 is 104,000 loaves per year. If she employs an assistant, that will increase her fixed costs and therefore raise the break-even point. If she gets cheaper equipment, that will reduce her fixed costs, so lower the break-even point. Selling at 90p will reduce revenue and therefore raise the break-even point. Cheaper flour would reduce her variable costs and therefore lower the break-even point. Budgeting. Jill and Amy both want to buy a jacket for £60 in the sales. Jill has got £30 in her purse and she thinks if she can cut down on her spending, she can save the rest in 3 weeks. Amy has no idea how much cash she has and she still owes her mum £5 from last week. She decides to forget the jacket. Which of them understands budgeting? It is clearly Jill. Budgeting is financial planning. It involves setting targets for spending and revenue over a future period of time, and in business it can be used for forecasting startup costs, introducing a new product or a building extension, and as part of forecasting sales. The main purpose of budgeting in business is to make sure that you're in control of your revenue, the money coming in, and your expenditure, the money going out, so that you can make a profit. You often base this year's budget on last year's budget, last year's financial information as a guide, but also you want to be stretched. So think about future predictions about your revenue and your costs. The budget should be realistic, but also challenging so that you do your best and you're motivated to work hard. Once the year has started, you need to compare your budget with actual figures. So maybe do that once a month. So if we are underperforming, we need to find out reasons why. So for example, are sales lower than expected? Are we overspending? Okay, because if so, we need to take action. Okay, now maybe it might be that the original budget was unrealistic, in which case we could change the budget for the rest of the year. Budgeting is very important. You have to have an idea of what your costs are going to be, as well as your income. So you need to monitor this. So as the year gets underway, see if you're underperforming and why. Or maybe you are performing better than you expected. So again, why? If you don't budget, then you will have no idea about your likely costs or your income for the future. And you could run out of money and potentially you could go out of business. Now, if you are a new business, it's more difficult to budget because you've got no figures from last year, have you? So you're doing everything from scratch, so it's a bit more difficult to make predictions. Guys, thank you for listening. Please could you subscribe and like, as it helps us to produce more and better videos like this in the future. Also, could you comment below what type of information you would like in the future as a guideline for us. Thank you again, guys, and see you all again soon.